welcome back to Down the Middle. I hate to use cliches, but here with me today is a living legend, at least in my mind, and a fellow veteran of the Dallas Federal Reserve. So, I mean, he started in 1969. I started a few years later. But Dr. Lacy Hunt, Chief Economist, Hoisington Asset Management, 27 years that you've been there. Your quarterly letters they're the most circulated documents on Wall Street, and you've been
I doubt
so right
that.
for so well that I get several emails every single time from all around the street. Have you read his latest? Have you read his latest? Have you read his latest? So welcome. It's so good for you to be here.
Nice to be with you, Danielle.
I'm happy that this is part of the Austin series that's being hosted by Artemis Capital. This is just fabulous.
Yeah.
So
I want to thank you for putting the Dallas Fed on the map.
well, I don't know that Timothy Geithner or Bill Dudley would have the same sentiments in terms of my influence at the Dallas Fed, but thank you. Let's go back to those days at the Dallas Fed when you first started. You started when William McChesney Martin, who's the longest serving Fed chair through, I think, 4 presidencies?
Well, he was appointed by Truman.
Mm-hmm.
He served under Eisenhower, and he then served under Kennedy, and then LBJ, and very briefly under Nixon.
5.
Nixon did not reappoint him, but Nixon then replaced him with Arthur Burns, who was chairman of the Fed when I left the Fed.
Right. We'll get to Arthur Burns in just a moment, because a brilliant economist.
Yeah, he was.
But last night you were telling me he was a brilliant economist. But prior to coming to the Fed, something that I think we need another one of today was the 1951 Treasury Federal Reserve
Very
Accord.
critical. Mm-hmm.
William McChesney Martin, he basically shepherded that process.
It could not have been done. He was Under Secretary of the Treasury for Truman
at the time.
And he had a great personal relationship with Mariner Eccles, who was chairman of the Federal Reserve Board. And as soon as he negotiated with that, and with Eccles' term coming to an end, he then
he was in the right place at the right
yeah,
time?
He worked Harry Truman. And Harry Truman then appointed him. And what's very interesting, Martin was a Democrat, but he functioned best when he was working with Dwight Eisenhower, who was a Republican president.
Mm-hmm.
And they were able to work together for the best interest of the country. And after Eisenhower left and Johnson came in, the relationships deteriorated badly. In other words, his tenure and his record was badly hurt when he had to deal with the presidency of a president from his own party.
From his own party.
And so, but working with Eisenhower, both men were able to rise above their partisan differences and do the right thing, generally speaking.
Well,
not that they didn't make mistakes, but the monetary policy and fiscal policy in those days, by what we've seen since then, it was outstandingly good.
Well, there was infrastructure spending that increased long-term productivity during the Eisenhower era.
Yeah.
I mean,
we built the interstate highway system.
Exactly.
And we paid for it by a nickel tax.
Well, that was the thing, and that's what people don't appreciate, is that infrastructure spending of the kind that we've seen in the past 30 years or so, it accomplishes something north of nothing for productivity.
No. Well, that was not debt financed.
Right.
That was funded by average, ordinary Americans. And so we have these great examples of the debt finance shovel-ready projects of 2009, 2010. You get a blip in economic activity. Within a quarter or two, business conditions began to deteriorate. We saw the debt financed tax cuts of 2018. You have one good quarter, another quarter is sort of okay in 2018, and then the growth rate begins decelerating, continues faltering all the way through 2019. The clear record is that when you're massively over indebted, such as we are today, and you take on more debt, you push the economy further along the diminishing returns curve.
Right.
And so, but most people, all they can see is the bridge going up. And they think the fact that the bridge going up, unblocking the traffic, is somehow a boost to economic activity. But what they don't understand is that there are complex relationships that cost more in economic damage when you do it with debt. And if a program is truly meritorious, and the public can see this, as they saw with the Interstate Highway Program, when President Eisenhower laid it on the table, the public will support it. But the public doesn't really support a lot of these programs.
No.
And so they have to be debt financed.
No, I mean, you know, we'll digress for a minute, but you know, when you hear President Biden say this is fantastic, it's going to create a lot of union jobs, you say to yourself, you're announcing publicly that the taxpayer money that's debt financed is going to be wasted and squandered. But let's stay with McChesney Martin for a few more minutes, because we're here in Austin, Texas, and LBJ, of course, has his ranch outside of Austin, and there was a very famous moment of legend. I mean, we weren't in the room when that maybe you can tell us about.
It's possibly apocryphal. I happen to believe it, based on the people that told me the story. When Martin began tightening there in the mid-'60s to try to contain the Vietnam War inflation, Johnson heard about it on Christmas Eve night. And he sent 2 Air Force colonels to Martin's home and asked him to come to meet him and explain what he had done. And he tried to convince Martin to reverse his decision.
That was said very diplomatically.
Yeah.
Tried to convince.
Well, he basically was very, Johnson tried to use the power of whatever power he had. He was a very blunt politician, and he was able to get certain things done. He pushed through the famous civil rights legislation. But he used a very, very blunt instrument. And keep in mind that by this point in time, the Vietnam War was becoming increasingly unpopular.
Right.
And it was so unpopular that there was no prospect that they could raise taxes to pay for the Vietnam War. And as a consequence, in the early phases, the Federal Reserve was allowing the money supply growth to accelerate. And then, unlike now, the velocity of money was stable, and so it started feeding this inflationary process. And so Johnson didn't want the public, growing increasingly nervous about the war, to have to absorb any more negative news.
Right.
But Martin was the only one left to try to do something about the problem. And Martin did begin moving, but he was not able to move in a timely fashion, in a sufficient manner. And the fact of the matter is, we had quasi-recession in 1966 and 67, and then we had another recession in 69 and 70, all a consequence of the higher inflation and what the Fed ultimately had to do to bring the inflation under control. And so from economic policy standpoint, the Johnson administration unfortunately gets an F. In terms of civil rights legislation, they get an A+.
Sure.
But in international economic policy and domestic economic policy, horrendous mistakes were made. And ultimately, the Vietnam War inflation had changed the whole inflationary dynamic. And it really wasn't until Volcker came in '87, in the midst of a crisis, that this is all really originated out of the failures of the Johnson administration. And I know there are a lot of Texans that will say, Lacey, you shouldn't say anything about your fellow Texan, but the fact of the matter is, the facts speak for themselves.
Well, I mean,
it's not a good episode of American history.
And you know, I've read in several places that he pushed McChesney Martin up against the wall at the ranch and said
He
there
may
are
have.
boys dying in Vietnam. And yet, what did McChesney Martin do when he went back to Washington, D.C.?
He did not reverse it, but they moved in a more timid manner.
Reminds
In
me of
other words, he was
Yellen era.
intimidated. He
Right.
was intimidated. And so the Vietnam War inflation gathered momentum. And then later on, and that episode is very important to remember because in inflation, prices rise faster than wages. That's one of the characteristics. And when prices rise faster than wages, that puts a very, very heavy burden on modest and moderate income households. And so when you're facing these basic necessity cost increases, you then begin to lose confidence in political leadership in Washington.
Right.
And so even though the GDP was growing rapidly because we had all the military expenditures and so forth and so on, the vast majority of our households were getting worse and worse off. And of course, Johnson's popularity went down sharply, and he did not run for re-election.
So we could have just had this last 5 minutes of discussion and filled in the blank with a different president's last name.
Absolutely,
So
absolutely. It's totally appropriate.
We have typically seen, as you have written, inflation decline into a recession. But of course, we had a 2-month flash recession in March and April of 2020. And then the fiscal spigots were open, trillions and trillions of dollars directly injected into American households' checking accounts.
And it had an impact, but it's not like the 1970s. There was another. The inflationary dynamic had certain major components. Number one, money supply growth did accelerate. And we had a 10% increase in the money supply in the 1970s. And it steadily went up.
I think it's the steadily part that's key here.
Yeah, it is. And it was not just Martin, but Burns and G. William Miller. Miller made egregious mistakes. But in that time period, also, the velocity of money was stable. So when you get a 10% increase in money and velocity is stable, you get 10% increase in nominal GDP. But another very, very critical element in the 1970s is that we had the largest devaluation of the dollar in any decade in our history. People don't remember that. But we had, first of all, the devaluation of the dollar in August of '71 by Nixon when he closed the gold window. And then the dollar was pushed steadily lower over the balance of the decade by Burns and then Miller. And when you have rapid monetary growth and velocity is stable and policy is pushing the dollar down, then what happens is in a lot of industries the price leader is a foreign producer. So when the foreign producer raises prices, the domestic producers have an umbrella under which to raise prices. And today, although we've had a very nasty bout of inflation, and money supply growth was quite rapid.
Oh, it was, if you look at the M4 aggregate, it was, I think I sent you a website recently, it was 30% in June of 2020.
That's correct.
The growth rate.
Yes, but the fortunate thing for us, it couldn't negate the whole impact, but the velocity of money was coming down. And now the money supply is finally...
Oh, it's down to like 5%.
It's now decelerating. The velocity of money is not only stable, it appears to be declining. And moreover, unlike the 1970s when you had a massive, unprecedented decadal devaluation in the dollar is working its way higher.
Steadily, that's the
another
untold
big
story of
difference.
2021 is the
Yeah.
dollar's steadily, it's not a massive appreciation, but it certainly has.
But it's in contrast to the 70s. People are drawing this comparison to the 1970s. The 1970s, you have to take into account what happened to the dollar.
Right.
And that will always stand, probably. I mean, maybe there will be something But so far, that is the zenith of dollar depreciation, was the 1970s. And the other, of course, major difference then is that we had very powerful demographics. The average age in the 1970s was 29. Today, we're approaching 40. We had a very vibrant birth rate, household formation rate.
Right.
We were a young population.
That had a birth rate that was higher than 1.4 for every married couple in America. But birth rates come crashing down.
That's correct. And we also were a very lightly indebted economy. Mm-hmm. The government sector debt was beginning to rise because of the Vietnam War, but the private sector debt was not rising. You still had the nightmarish, there were many people that had lived through the nightmare of the 1930s, and that scarred a lot of people's attitudes about death.
Right.
So in the 1970s, the marginal revenue product of debt was relatively stable, the velocity of money was stable. So the comparisons that people are drawing between now and the 1970s, in my opinion, are not germane. I mean, we have a nasty inflation. The current rates of growth are back where they were then, admittedly, but the underlying fundamentals are dramatically different.
Well, speak to the here and now, because the latest data show that wage inflation, that price pressures are rising faster than wages. You've done some interesting work on the percentage of American households who are suffering right now because of inflation.
Mm-hmm. I think basically right now about 80% of our households are suffering from a decline in their standard of living.
That's
and this is number. Really hard. It creates serious hardship. These families really do not have recourse, and because the inflation is in these basic necessities, like food and fuel.
Right.
And
I saw this morning that beef prices are rising 21% year over year.
And see, food and energy are what we call price inelastic. You don't really have good substitutes. And so the modest and moderate income households, their share of basic necessities of their total budget is much higher than the upper income households.
As well as housing, my goodness.
But there is also an international effect going on here, because in the emerging economies of the world, which have considerably less per capita income than we have, the percentage of their budgets for basic necessities is dramatically higher than it is in the United States.
And their currencies are getting
Their currencies
slaughtered.
are falling.
Yep.
The commodities that they buy are priced in dollars, so the dollar is going up, not dramatically, but it's moved higher. So for the emerging economies of the world, the impact on modest and moderate income households is very severe, and I think that the damage of inflation will be seen, and the thing that has allowed it to perpetuate itself is the fact that money growth was very rapid, but the money growth situation is changing, and each month that they taper, we will see slower and slower monetary growth. And so the picture right now looks very, very nasty. And one of the things that people are constantly asking me, well, when do you see the inflation breaking? And I have to be candid, I don't know. But I know that the process is at work. And as a fixed income investor, I don't want to be off sides.
Sure.
So if there's going to be difficulty over the near term and I have to sit through it, okay, I won't like it, but I don't want to be off sides. Another important element that's at work, and this really goes back to the important contributions of Arthur Burns and Wesley Clare Mitchell. And they looked at, they did the cycle dating, and they broke down various critical economic indicators into
this was
leading.
The formation of the National Bureau of Economic
That's
Research
right.
that you were talking about.
And then we should never forget that. It was Burns and Mitchell. And one of the things that they noticed, and their work was 50 years ago, that inflation is a lagging economic indicator, that when a recession ends, the inflation rate still goes lower. It's not until you get into a well-advanced expansion that the inflation rate goes up. And the way that Burns and Mitchell explained it is quite compelling. And he said, when you're coming off a deep recession, you need the inflation rate to fall for basically three reasons. First of all, if you have inflation, prices rise faster than wages. Mm-hmm. Well, if prices rise faster than wages, you immediately throw this adjustment onto the components of the society that are least able to deal with it. You undermine real wage income.
It's a regressive tax.
Absolutely, it's a regressive tax. And so the irony of the failure of monetary and fiscal policy is that they are saying these wonderful things to moderate type households, and they're taking policies that actually damage them the most.
Absolutely.
They're putting the damage of their failed policy on their own constituencies. And so, and we've seen other administrations and other policies do the same thing. So you need the inflation rate to come down so that wages rise faster than prices. In addition, you need the prices to come down so that our manufacturers can sell more to the rest of the world. We need an improving trade deficit. We need the trade deficit to come down. All right, well, when you get higher inflation, what happens is you import more foreign goods, you sell more domestic goods.
And we've certainly seen that.
So we're seeing, what are we seeing this year? We're seeing a much larger trade deficit. And what we need is we need for the trade deficit to be improving. And I think, Danielle, this will be seen here, but once the ports clear, mm-hmm. we may find that we have a lot more deterioration in the trade deficit than has been reported so far.
Well, I mean, there are increasing reports of companies stockpiling inventories. So, as opposed to the just-in-time.
Absolutely.
And you know,
well, they say these pendulums swing all the time.
Of
you know,
course.
in other words, you want to go hand-to-hand inventory just in time, and then the hand-in-hand doesn't work, like because of a pandemic, and so it's like the generals, they always fight the last war.
Right, of course.
And so right now, what everybody is attempting to do is to have more than sufficient inventories in case of a
just in case.
Yeah, just in case.
From just in time to just in case.
Well said. Yeah. I appreciate that. So what we're seeing is that firms are probably double and triple ordering, and I suspect the same thing is happening with job postings.
Oh yes.
In other words, they do whatever they can to try to obtain employees. So the current numbers look very, very robust, but ultimately it reverses. And the other reason you need lower interest rates is that this causes the nominal rates to fall, which boost your interest-sensitive sectors. Well, this year, the interest rates have risen. They haven't risen a great deal, but they've risen. But normally, in an early stage expansion, you need the interest rates to fall. And so the mechanism, the cyclical mechanism, and it's not just by saying it's a lagging indicator, there's a good reason that the inflation rate and interest rates need to fall in an early stage expansion.
So
it undermines the whole process. It's not just a historical phenomenon. It's a theoretical underpinning to it.
So let's talk for a bit, because I've been writing increasingly at Quill Intelligence about cycle compression. I've never seen anything like this. The shortest U.S. recession that preceded, and I cannot imagine having been at the National Bureau of Economic Research and trying to say when the recession started and ended. That must have been quite the task. And then to put a number on it of 2 whole months. But the shortest one prior to
1980s, yeah.
was, yes, the 6-month recession that ended up compressing in the aftermath a cycle. And whether you're talking about car sales being down 7 of the last 8 months, I mean, I think car sales being down, I think there's more than there isn't enough supply out there. 7 of 8 months out of the last 8 months is a trend. And we've seen house price appreciation roll over, and the bidding wars have stopped. And you know, the Lacy Hunt school of thought tells you that housing and autos lead every economic cycle into and out of recession. But regardless of the indicator you're looking at, I mean, in September of 1969, when you were just at the Dallas Fed, and we saw jobless claims print as low as we have recently, 2 months later, the economy was in recession.
That's correct. Yeah. It can change on a dime, and that's why I've been trying to recommend to our clients that yes, we have a serious problem with inflation by all the current indicators. The inflation has spiked more than any of us thought. It's lasted longer than what it's thought. But it sows the seeds of its. Another thing that happens, and this is just basic economic theory from the aggregate demand and supply models. When you have a series of supply side disruptions, the upward sloping supply curve shifts inward. So you've got prices over here on the vertical axis and real GDP on the horizontal axis. So when you have the supply side disruptions, the supply curve shifts inward. Well, that takes the price level higher, but it reduces the GDP. When you reduce the GDP, you increase the output gap against trend. And in other words, the higher prices serve to destroy demand.
It acts as a governor.
Yeah, it acts as a governor. Now, what some people are saying is that the Fed is in the process of shifting the aggregate demand curve outward, and which is what happened during the 1970s. Well, the reason the aggregate demand curve shifted outward is that money supply was accelerating. It's still high, but the rate of growth is coming down. And the velocity of money has been declining, and we think it's going to still decline. And so the aggregate demand curve is not going to shift outward.
We're seeing commercial and industrial lending collapse.
Yes, we are. We are. So we have a difficult situation in here. It's the trading, particularly in the fixed income markets, which is my focus, is very volatile. But in spite of this and very, very high inflationary numbers that we've continued to see, the bond market late last year and early this year anticipated the higher inflation. The rates moved up. And although it has been very difficult and people find it hard to believe, the very inflationary, economically sensitive long Treasury yields have managed to sort of work their way down. It's the hardest process in the world to live through.
Of course.
But it basically is happening. And
well, we've seen, I mean, if you look at the yield curves, if you look at the most commonly referred to yield curve, the 2-year Treasury versus the 10-year Treasury, when the third stimulus check was sent out in April, the divide between those two yields was nearly 160 basis points. That's been sliced in half.
I know.
I've never seen a yield curve compress as rapidly as it has since April. It's just remarkable to watch. The high end, the talking heads on Bubble Vision, all they're talking about is short end rates coming up, but nobody's really talking about how violently the long end of the curve is fighting back against this.
And one, I'm not really an expert in this, but I have a friend who follows the Eurodollar curve. And the Eurodollar curve, which has a shorter history, obviously, but has shown some unusual prescience. in beginning to go negative before economic problems. So you not only have the compression in the Treasury yield curve, which you're talking about, but the Eurodollar curve, which has had this uncanny ability, at least in the last, say, 10 years,
Right.
to sort of sniff it out first, is saying basically the same thing, that investors are trying to look through. Now, it's difficult because the traders see these bad numbers coming through, and people are upset, and inflation's in the headlines, and we know that if inflation were to be sustained over long periods of time, it would take the bond yield with it. So the critical issue is whether it's going to be sustained, and it's not a question of when the reversal occurs. It's the question of whether it's going to be sustained, and I'm in the camp that it will not be sustained.
Well, if you just look at the political landscape right now, there's pushback against maintaining the child tax credit being delivered to households in cash every month. And some estimates suggest that 90% of U.S. households with children is receiving this, and clearly 90% of U.S. households with children do not need this cash subsidy.
Yeah.
But it looks like it's, it doesn't look like it's going to be extended into 2022, and that is kind of your last burst of a true cash infusion that ignites price inflation.
Well, and the thing about it
interim.
is, while it may have helped some families, the fact of the matter is, and this, to my way of thinking, the child tax care credit, and don't get me wrong here, I'm in favor of children. I have 3 of myself. I have
Yes.
4 grandchildren. I'm in favor. I'm in favor of families and
course.
children and
Child
all
care
of
should
these
not be
things,
prohibitively
but
expensive.
No,
I
but
completely
the fact
agree
of the
with that.
matter is, when your policies result in dramatically higher inflation, that's anti-children and it's anti-family.
Right.
I mean, let's
Again,
just face
it's
it.
regress. I mean,
Totally regressive.
There's a
And
clear
so
misunderstanding.
and you may say, well, but your head's not screwed on. You're not being sympathetic. Well, I say, no, I am being sympathetic.
Of course.
I'm trying to deal with the reality of the situation. And let's lose sight of the fact that it doesn't just hurt our families and our children. Think of what it's doing in the emerging markets.
Right. It's tremendous. So if you look at the trend that preceded the pandemic, because I'm going back to your observation that job openings are probably wildly overstated right now. If you look at the trend pre-COVID, there's a deficit of 8 million jobs that have not been created. That's the gap between where we are today
I think that's the way to look at it, Danielle.
and where we would be
I
if we were
haven't
still
done
on
that
trend.
calculation, but I can see what you're talking about. One of the tools that I like to use is I'm interested in how we're performing relative to our trend rates of growth. If you look at, we have very good economic numbers from 1870, and from 1870 to 2000, in real per capita terms, we grew at 2.2% per annum. There's tons of academic research that shows that by 2000, we had become a heavily indebted economy. And since 2000, we have become far more indebted. Now, the academic studies showed that once you reach the excessive debt levels that we had, by at some point there in the late 90s, early 2000, we should have lost about 1/3 of our growth rate against trend. So we were growing at 2.2 from 1870 to 2000, real per capita terms. Since then, through the third quarter, we're only growing at 1.1% per annum. So in the third
cut
quarter,
in half, literally.
Yeah, in half. And so get out your compound interest tables and compound at 1.1% for 22 years. Makes a huge difference. So when at the end of 2019, before the pandemic hit, our real per capita GDP was 17% below trend. Now we're 23 or 24% below trend.
I don't think anybody appreciates that.
No, and that's the critical. We're falling further and further below the trend. So when your growth rate of the standard of living starts falling, and we've seen this time and again, the United States, other countries, the income and wealth divides increase.
Right, of course.
So the policy may talk a good game. We're out to help the downtrodden. You know, we're your friend. We're taking policies that are compatible for you. The Federal Reserve is symptomatic. The government is, we pass through, we issue major debt finance programs to do this and do that. And the net result is that we're making us all collectively worse off. Mm-hmm. And where does the burden fall? Does it fall on the high end? No, of course not.
Fed policy makes sure it doesn't.
No, but the Federal Reserve can only attempts to look at has a very narrow focus on the here and now. They're not willing to look to a broader view of the consequences of their policy, and as a consequence, we're getting greater and greater failure. The only solace in the whole picture is that since the 1995, or when the EU came into power, we are outperforming Europe and Japan by a wide margin in real per capita GDP growth. They're falling, they're more indebted than we are, and they're producing even worse results. And another element that's at work here, and this is a lot of what I've been talking about is 30,000 feet
right
above sea level, but now I'm going to take it up 40 or 50. Okay, so when you coordinate monetary and fiscal policy, which was never the intent. Monetary policy was supposed to be independent of Federal Reserve policy, that you did not want the two central policy makers doubling up on policy mistakes.
William McChesney Martin, 1951.
Absolutely.
Separating the two.
Absolutely. This is what you need. And so when you coordinate monetary and fiscal policy, such as we did last year in an unprecedented, probably in violation of the Federal Reserve Act, what you do is you move the total economy further and further in the direction of command and control. All right, so when I say that, what that means is that the influence of the government sector over the economy is becoming greater. All right, now what we have learned from massive amounts of academic research is that the debt finance government multiplier is negative after 3 years, maybe sooner. There is no Keynesian multiplier. I know that's what I was taught in the 1960s. In fact, I believed it was 4 or 5. Now we know that it's negative 30 cents. In other words, if you engage in $1 of debt financed activity, at the end of 3 years, you get the increase in $1 of debt finance something, but you lose private spending of $1.30. So when you...
I'm going to interrupt you for a second. What are those similar numbers? Because you put a great table together. For Europe and Japan, they're even lower.
They are even
and China.
lower. They're even lower, and they're more indebted. And so when you go in the direction of command and control, you reduce the private sector activity. The private sector has positive multipliers, all right? When you increase the command and control component, you increase the government activity, and they have negative multipliers. So when you move further and further into the direction of government control, you get increasingly inferior economic results.
The law of diminishing returns.
The law of diminishing returns, absolutely. And so the results are going to continue to get worse, but yet the policy approach is that we're here from the government and we're going to help you, and disregard the fact that we can't run the DMV or the post office or process the IRS or whatever, but we're going to do it more efficiently, and we're going to make you better. And the net result is that we are falling further and further below the trend.
Right, and this
Now,
is what Milton Friedman warned of.
That's what he warned of. Now, I don't have any fight in this game. I'm not trying to change anybody's attitude. The reason I'm concerned about it is because I'm a fixed income investor. And I'm just trying to execute a fiduciary responsibility to my clients. And so when you hear about these massively unprecedented debt finance programs, the initial impact of the market is that it's going to be inflationary. And as the last year has shown, it can be inflationary. But the issue is not what we do over a limited period of time. Mm-hmm. It's where we take the economy. Are we making people better off by these decisions? And the net result is that we are not.
No, our labor force participation rate appears to be structurally lower in the aftermath of this moment,
Absolutely.
this flash recession. And it does not look like it's going to come back. It looks like you're going to have millions of people who are sidelined for the rest of their lives.
Absolutely.
At young ages.
And there's another corollary here too, is that we not only have the comparisons that we can make in terms of the US versus Europe and Japan and now China, but we have comparisons within the United States. We can look at the heavily indebted economies in the upper Midwest, the Eastern Seaboard, the Western Seaboard.
Right.
And they're trying to move their own state operations further in the direction of demand and control. So what is happening?
There was a fourth stimulus check in the state of California.
Absolutely. And so what is happening is it's forcing a tremendous migration of capital, labor talent, particularly young labor talent, into the states that are moving against this trend.
Right.
So, but think about that. So when you lose bright young people and you lose capital because of a migratory change within the United States, you leave holes on the East and West Coast.
And Illinois.
Yeah, and Illinois too, and some other states as well.
Right.
And so the process should be abundantly clear that the track is not positive for economic growth.
Not in the aggregate.
No, there can be these episodes. There we had a brief, as I said, a brief span of it looked good there for a while in the shovel-ready projects. The same true with the tax cuts of 18, but it just fizzles. And we have about 40 cases in Japan and 25 cases in Europe. They are not working.
And
but
yet,
what do we keep doing? We keep going back to the well, hoping that this time will be different, but it's not different.
well, and to listen to kind of the sell side say that this infrastructure spending bill is going to keep inflation rising, I'm saying to myself, how do they not connect the dots?
I don't know.
Between all of Japan's programs that have failed, all of Europe's programs that have failed, Obama himself came out and said that it did nothing for economic growth, his shovel-ready infrastructure spending. It's incredible to me that we keep hearing that this new infrastructure spending plan is going to further ignite the flames of inflation.
Yeah, well, there's a difference between shovel-ready and shovel-wise. We have to make wise decisions.
Yes, we do.
If we don't make wise decisions and we think through the whole process, then we're not going to produce better results. Let me give you just an example, one well known from history. The great Sir Isaac Newton gave us the laws of gravity, which held until Einstein gave us the theory of relativity, and then that invalidated them. He was a tremendous thinker, but he believed that you could mix mercury and lead and you could get gold. He was an alchemist. And so
He would have made a great central banker.
Yes, he would. So his thought was that he had started with too small of a quantity of lead and mercury. And so he said, well, what I need to do is I need to up the size. And so he upped the size And what happened? The result's not any different. In other words, he's just repeating the basic process. And then what does he? He dies of lead and mercury poisoning. So the fact of the matter is here, when it comes to economic policy, there is the economics has been superseded by accounting. But economics is not accounting. In accounting, more is more. So if you have $2 billion of profit and you have 4, that's better. So the accounting mentality is that if you try with a $10 billion program and it doesn't work, then what you should do is you should go to 20. And if 20 doesn't work, you go to 30. But one of the most basic concepts in economics is the production function. The production function is universal. It works at the micro level and the macro level. The aggregate demand curve is not an aggregate of micro demand curves. But the production function, yours and mine, can be aggregated. The production function of the state of Texas can be aggregated with that of Oklahoma. We can aggregate them all. We can aggregate the national production functions. It's one of the bedrock concepts in economics. And what the economics profession is trying to do is to rely on the micro concepts that hold also on the macro level. Now, the production function says that economic output is determined by technology interacting with land, labor, and capital. If you begin to make greater use of one of the factors of production, such as debt capital, initially economic output rises. We call that increasing returns. If you make further use of debt capital, GDP flattens out. It calls steady returns. And then if you still insist on using more debt capital, you go to negative returns. So what the law of diminishing returns says is there is a phase in which debt can be used productively. Doesn't that make sense? Isn't there a phase that almost anything can be used productively? Then there becomes a phase when it is not effective, but it's not harmful. But now we're at a phase where the overuse of debt capital is so great that it is detrimental. I mean, it was created by Ricardo, the great David Ricardo, who really did more for founding economics as a profession than Adam Smith. Tremendous thinker. And it holds applicably, and so what do we see? We borrow less, but the benefits keep getting weaker and weaker. And the process in Japan and Europe are proceeding at a deteriorating pace relative to what we are, and I think China's about to, because they're extremely over indebted, and the problem there is that there are data issues.
Oh gosh.
And it's difficult for me to quote the Chinese numbers because we've got riddled with inconsistencies of the debt data and their GDP data. But what is interesting is that you can sort of infer what's happening by looking at the velocity of money. It's the biases there are less. So velocity in the United States peaked in 1997 as we started hitting these high debt thresholds where the deleterious effects become more pronounced. Every dollar of new money created $2.20 of GDP. We're now down to $1.10. In Europe, in the EU, the velocity of money is 0.85. In other words, each dollar of new M2 money in Europe is only creating 85 cents of new GDP. In Japan and in China, this is what's interesting. The velocity of money is under 0.5 in both areas, which suggests that it's kind of indirect confirmation that there's something terribly wrong with the Chinese data. And, Brookings had a lengthy study about their GDP. They did a forensic study. There have been anecdotal, the only Chinese data that I will put on a table is their velocity of money. Because the others, I don't want to have to answer questions about the validity of the data. And I don't want to go there, and I can't get into that debate. Because what they're presenting and the reality appear to me to be vastly different.
Well, and that brings us back to the subject of demographics. And we're a generation behind Japanese demographics, and China's got a big demographic issue that's building.
I have a little statistic I'll give you.
Sure.
The average age in China now is approaching 41. We're at 39. But they had the one child per family, and then they had a lot more boy babies than girl babies. I'll just put it that way. I'm not going to say anything else about it. If you want to know more about it, look it up. I'm not going to say it because it's too politically sensitive. But, okay, so now they've got this huge mishmash between young men and young women. And as a consequence, every year, the average age in China, every 2 years, the average age in China is going to go up 1 year. So they're going to age very, very rapidly. And we're moving in that same direction. We're just further back on the curve. And
well, our population growth has collapsed.
It is. And what people don't understand is that positive demographics have a major impact on economic growth and inflation. Now, I know there's a very famous book out that says the aging means we're going to have more inflation because there's going to be fewer workers to hire. But that's not the way the world works. The demographics work through investment on economic growth and inflation. Just think about this for a second. Think about the cost of forming a household. Think about the cost of raising children and the investment that requires. Thinking about the cost of educating the children. All right, think about the investment required by the firms that produce for growing households. They have to invest more. Think about the investment that has to be made by state and local governments. In vibrantly growing areas, you need more subdivisions, you need more water and sewer, you need more schools. So the demographics, the impact of having fewer bodies to produce things is there, but it's always outweighed by the impact of investment, of the impact of demographics on investment. And so the negative demographics are a huge anti-growth, anti-inflation force. It doesn't mean that it operates every month or every quarter, but it's there. It's a constant
it's a slow
influence.
Drag. It is.
But everywhere I go, people tell me, well, the demographics are going to give us higher inflation because we have fewer bodies. And that effect is there, but it will just be overwhelmed.
So let's shift to the Federal Reserve today. Given everything we've just talked about with the law of diminishing returns, unless there's a law change, and we'll go there, but unless there's a law change, is the Fed capable of inflating away the national debt?
Without the law change?
Without a law change.
Okay, let's see. I think that it, I don't see how that they would be able to manipulate the Federal Reserve Acts. When we left the gold standard in 1933, the Federal Reserve Acts had to be rewritten. And the job fell to the shoulders of Senator Carter Glass of Virginia, who was a newspaper man. And he didn't really know much about economics or finance, but he knew where to go to find out. And it was Carter Glass that also gave us the famous Glass-Steagall Act.
Right, of course.
Which I think was better legislation than what we replaced it with. But anyway, that's neither here nor there.
That's a different story for a different day, but I'm going to have to agree with that.
It worked very effectively. It was
Yes,
only
it did.
10,000 words. I mean, it was a very beautifully written piece of legislation. Glass also wrote the Federal Reserve Acts. And he knew that he wanted to give the Federal Reserve power to prevent liquidity problems, such as the failure of the Knickerbocker National Bank or the run on banks that occurred there in the 1920s and early 1930s.
Chicago, there was Continental and
Yeah.
Chicago.
He wanted to be able to prevent that. But he did not want to give the Fed the power to spend. The power to lend, not the power to spend.
Right.
And the two leading monetary economists at the time were Irving Fisher at Yale and Charles Whittlesey at Wharton. I actually knew Whittlesey. I saw him when he was an emeritus professor. He gave me my macro orals at Wharton. But anyway, so,
Wow.
so he said to them, how can we give the Fed the power to lend but not the power to spend? And that's the way the Federal Reserve Act was created. He did not want to make the Central Bank of the United States a banana republic bank.
No.
Because that we by that point in time, we had numerous instances. We knew the Germans made their central bank, they gave them the power to spend, to help pay the reparations and to recover from the cost of World War I, and it related to Chiang Kai-shek and his central bank were given the power to spend in 1935, which then set off a tremendous inflation in China, just like no one knows about it because they never studied the Chinese history very much. But it was equally as horrendous as the inflation in Germany. And there are many, many cases of historic empires and Latin American countries. If you give the Federal Reserve the power to spend, then in that case, you will begin to get rampant inflation.
Well, and that's why, and we can talk a little bit about this, but that's why I think the renomination of Jay Powell is so critical, because he's not advocating for central bank digital currency.
He has said very explicitly that he is for the Fed to lend but not to spend. But you know, Mrs. Brainerd introduced a proposal to give non-institutionalized adults an account at the Fed. Now this would circumvent that. Now, but to Mrs. Brainerd's credit, she did say that this would require a revision of the Federal Reserve Act.
Of course it would.
But the issue for me, and I don't know the full answer, is whether the Fed could, under some exigent circumstance, there's an exigent circumstances clause.
13.3c.
Yeah, that they might try to do it. But this would change our whole structure. And of course it would then totally invalidate the value of a bank deposit. Because now, instead of having an indirect guarantee of your bank deposit, you have a direct degree from the Treasury. And then all you would have to do is to use the Federal Reserve liabilities to go into the accounts.
That's a full marriage of the Treasury and the
It
Federal Reserve.
would create the same thing. So you would then make the U.S. Central Bank the spender of last resort. And in short order, we would trigger Gresham's law. The bad money would chase out the good, inflation would take off, none of us would be immune, and the biggest burden of all of the inflation
Right.
will fall squarely on our modest and moderate income households.
Well, we've seen-
and very few in the upper income. Virtually no one survives in hyperinflation.
We've seen CBDC, central bank digital currency, we've seen it taken for a test drive. with all of the money that was directly injected into households.
Yeah, it was.
And it proved to be inflationary.
It did.
And if it was to continue, and I think that that's what the modern monetary theorists should appreciate, if this was to continue, you would have inflation run away and you would slaughter economic growth.
You would. Well said, Danielle. A modern monetary theory, MMT, in my view, has already been tried, tested, and failed.
Absolutely.
Because what has happened is that the government debt levels have gone up and up and up, and the net result is that the economic growth rates have come down in real per capita terms. And so we've been made, and you know, we all know, especially people in Texas know, that the key to economic prosperity is hard work, creativity, ingenuity, and that's really the source of our wealth. It's not in some government program. Can the government do certain things at the margin? Yes. The interstate highway system,
Sure.
A great success. And there are other examples, but the over-reliance on debt is not the answer. And so what you're trying to do here is to make the Federal Reserve's liabilities legal tender, is you're moving further and further into the direction of command and control. And so in the Soviet Union, people had all kinds of rubles. There was not a shortage of rubles, but there was a shortage of everything else.
Right. There's just like in Venezuela where I lived.
Absolutely.
You know, there's no shortage of bolivares at all.
Yeah. So if we want to go that way, that's fine, but it will totally backfire.
Well, of course, they haven't been able to invest in their energy resources
No.
because of socialism. It's just been a complete disaster.
And by the way, the giving the Federal Reserve the ability, making their liabilities legal tender, is basically what happened in the latter stages of the Mesopotamian, Roman, and Bourbon empires. They became extremely over-indebted. There really wasn't a banking system. They were borrowing from moneylenders. The Bourbons were borrowing from some rudimentary banks. But they became so heavily indebted that the moneylenders and the rudimentary banks, when they did exist, would not lend anymore. So what was the answer by the once great Mesopotamian, Roman, and Bourbon empires? Well, they started issuing a worthless metallic coin. And immediately inflation went up.
And the inequality divide.
And the inequality, and Marie Antoinette said, "Let them eat cake." I mean, the real risk here is that at some point in time, we become so dissatisfied with our policies that we may take command and control to an even more advanced stage, which would be making the Fed's liability. And there are a lot of people advocating it.
There are a lot of people
I run into
advocating
it all the time.
Of course. And we would lose reserve currency status quicker than you could say Xi Jinping.
And that's an excellent point, because in these earlier cases, in Germany in the 1920s, Germany was not the reserve currency of the world. Chiang Kai-shek's China in the 1930s was not the reserve currency of the world.
Right. There's more at stake.
There is, and so where does, what, if you destabilize the anchor to the international monetary system because of the change in the Federal Reserve Act, then no one is left immune. I mean, someone has to speak up here.
Oh gosh.
It's
Trust
not
me,
my job. Not my job.
I'm really loud about it.
I'm just going to react to it.
Don't worry, Lacey. I'm really
You're
loud.
doing the best you can,
I am.
Danielle. We appreciate it.
I'm loud and I'm proud. Of course, I'm here in Austin. Why wouldn't I be? Let's go all the way back to the 1913 Federal Reserve Act. Prior to quantitative easing, the Fed held treasuries on its balance sheet, 800 some odd billion. But the 1913 Act stipulated that the Fed was not allowed to become entangled in any government-sponsored enterprise. And yet here we are today with the Fed's footprint, albeit diminishing, because as this taper continues at $5 billion a month for mortgage-backed securities. The Fed directly holds a third of the mortgage-backed securities market.
I didn't realize it was that high.
Well, but it is
Interesting
in
figure.
direct violation of the original
It is.
1913 Act. The Fed was never going to be allowed to deploy credit easing. And yet.
And that's one of the things that worries me, because we're supposed to be a nation of rule of law. And when I was in the Federal Reserve back in the old days, I was forced to read the Federal Reserve Act. You know, I didn't read it very well, but I did a speed read,
I was shocked
so
to stumble upon that government-sponsored enterprise,
It was
GSE,
very
Fannie,
boring.
Freddie. I was shocked to see that in the original act recently.
But there's an interesting story I'll tell you. There was the chairman of the House Banking Committee back in the 60s was a congressman from East Texas by the name of Wright Patman. And Wright Patman was a very serious critic of the Federal Reserve, and someone convinced him that the Federal Reserve, in fact, had the ability to print money. And so Wright Patman, to his credit, found the two leading monetary theorists of the time, or two of the three, Carl Brunner and Alan Meltzer. And he funded a lengthy study which he published to address the issue of whether under the Federal Reserve Acts the Fed could print money. And the publication is very valid. Carl was a mentor of mine, really a brilliant fellow, and I knew Alan quite well. Anyway, they concluded the Fed could not print money, that they could increase liabilities to whatever extent needed, but that the money supply was, in the final analysis, determined by not only the Fed's balance sheet, the monetary base, but the money multiplier. And that the money multiplier is an endogenous variable. Endogenous means it's not controlled by the policymakers. And so the Fed can inject the reserves, but to utilize the reserves, the banks and their customers must be able to profitably employ the reserves. And what we're now learning is when economies become more and more indebted, the risk premium rises, the risk of default rises. And so it's more and more difficult for the banks to pass through all of their costs to their customers.
Right.
And so if you look at the economic textbooks, they will tell you the money multiplier should have been 10 because the reserve requirement was 10. And so they apply the binomial theorem, voila, a $1 increase in reserves leads to a $10 increase in money. Now they have eliminated the reserve requirements. That was one of the steps that they took. And in spite of that fact, the money multiplier is down to 3, and it's moving lower. And in my opinion, it's going to continue to move lower because the Federal Reserve does not control little m. However, you circumvent the Brunner-Meltzer equation when you give the Federal Reserve when you make the Federal Reserve's liabilities legal tender. Because at that point in time, you meet the criterion of money. Money, and you can go to any major textbook you want, and all the minor ones too. Money has to have 3 criteria. It must be a medium of exchange. The Fed's liabilities are not medium of exchange. They sit on the Federal Reserve's balance sheet. They cannot be used to buy a football stadium or to pay salaries. It also must be a store of value. It's not a store of value. And it must be a unit of account. To be a unit of account, it must circulate freely. So the Fed's liabilities are not money. They can have an impact for a limited period of time, but ultimately it depends upon the interaction of the money multiplier and the Fed's balance sheet. But the analysis doesn't stop there because the money supply is not directly linked to GDP. because there's also another intervening endogenous variable called the velocity of money.
Right.
And the velocity of money is outside the Fed's control. And what we're learning is that when Fisher in 33 wrote that in highly indebted economies, the velocity of money falls. So what has been happening in the United States, Europe, Japan, China, as we become increasingly more indebted, the velocity of money is falling. And it's falling in line with the marginal revenue product of debt, which means the amount of GDP created per dollar of debt. And in other words, when the marginal revenue product of debt declines, it's confirmation that diminishing returns is at work.
Right. So you were working at the Fed when the Fed was given the labor mandate.
Yes, I was. What a mistake.
Okay, that answers that question.
That
was my question.
What a terrible mistake. Let me just correct it. I had just left the Fed.
Oh, okay.
I had just left the Fed. So.
Well, timing is everything.
Well, no, actually, I was there. It was in '71. So.
I thought it was in it was during Carter's administration.
No, it was Nixon. It was well. Maybe we were kind of a little bit. It was in '71 when Nixon imposed wage and price controls.
Yes.
And that,
and boy, I think Biden is thinking about it, which is scary.
That was the very serious mistake.
Right.
And it really compromised the Federal Reserve. It's another example of where the Federal Reserve lost its independence. Mm-hmm. So when Nixon closed the gold window, he did a variety of other things. He instituted wage, price, dividend, and interest rate controls. And he set up a dividend and interest rate control committee. And who does he tap to lead the interest rate and control committee? Arthur Burns.
Oh, gosh, yes.
The sitting chairman of the Federal Reserve.
Slight conflict.
Yeah, and so Burns is charged with holding the interest rates unchanged. And as the economy started heating up in 1972, as a result of the major depreciation of the dollar and a few other things that were marginally helpful, the economy starts heating up. Burns is holding the inflation, the Fed funds rate down. To keep it down, he had to keep increasing the money supply. And so the inflationary pressures build and build. And some people say that Burns was doing it because he was politically aligned with Nixon. And he had been appointed by Nixon. But the difficulty was, in my view, was not that Burns was doing Nixon a favor. Mm-hmm. He was executing his responsibility as chairman of the Interest Rate and Dividend Control Committee. And the labor unions had made it very, very clear that they would not agree to the wage controls unless prices were controlled and interest and dividends. And so this is a classic example, just as your case with Martin mm-hmm. and LBJ.
Right.
When you meld the two, then you violate the basic fundamental purpose of keeping the Federal Reserve and the fiscal policy makers separate. Bad things happen.
And that was institutionalized in 1978 with the formal change to the Federal Reserve Act, making it not from a singular to a dual mandate.
That's correct. One of the mistakes of my great inflation. The Federal Reserve should be, in my view, simply committed to keeping the inflation rate low, because that is the most beneficial thing that you can do for employment and for the well-being and welfare of the overwhelming majority of your households. It may seem not mm-hmm. that you're more caring to have a dual mandate, but if you really want to help the most people,
right,
you keep the inflation rate low.
And we look now at the situation that we find ourselves in, and Powell abandoning the inflation mandate in favor of maximizing inclusive employment. Mm-hmm.
I think that blew up on him.
has
It
pushed
had a bigger
him.
impact than I thought it was going to have.
Oh, gracious. And here we are, and the Fed is being forced to accelerate the taper. The Fed is being forced to potentially raise interest rates next year into a slowing economy.
Well, you see, when Powell last fall and the Federal Reserve said that they were going to allow the inflation rate to run hot, they didn't realize they really had lost sight of business cycle experience in theory, because in an early stage expansion, the inflation rate needs to come down. And they thought that letting the inflation rate go up would be beneficial. And there's no question that there are certain parts of our economy that did benefit, unquestionably. But the issue is not whether 15% or 10% were made a lot better off. The issue is what happened to the majority of your households in the inflation.
That's right.
And they were absolutely clocked. And so the Federal Reserve, in conjunction with the melding of monetary and fiscal policy, produced these counterproductive results. And now the Federal Reserve is going to have to try to reverse it by tapering and possibly raising the rates. And in fact, the odds of making that work, the empirical odds are not good. Not good. In fact, the Federal Reserve's record is quite checkered. We hang off their words, we react to them. They can make some surprise statement that can cause all kinds of volatility. But the fact of the matter is, these various pronouncements and the actions by the Federal Reserve have destabilized the economy. We've gotten worse results, not better results.
We've become much more volatile.
Much more volatile.
And you know, at the rate at which the yield curve is compressing, I mean, it would be the opposite of the not QE moment, when the Fed forcibly uninverted the yield curve, when it stepped in and started buying short paper. It uninverted that 210 yield curve. This would be the opposite. They would be inverting the yield curve, if given that it's the spread between the two is only 80 basis points right now, 79, 80 basis points. If the taper continues at an accelerated rate, I heard one economist say we might see the first rate hike in March of 2022, that the Fed will invert the yield curve.
I think we should really tip our hats to the wisdom of the immediate past president of the Dallas Fed, Rob Kaplan. He was one of the early advocates that the Fed should have pulled the mortgage buying once the home prices hit new records. And
make Austin unaffordable.
I mean, that was a real serious failure. But the Federal Reserve was not designed to get in the role of credit allocation. The Federal Reserve should concentrate on these broad macroeconomic fundamentals. And now they've got to extricate them from the mortgage situation. But just think if last fall, when we were setting these new records in home prices and home sales, if the Federal Reserve said that the economy doesn't need this $40 billion, which is basically what Kaplan and a few others wanted. Think how wise that would have been.
Well, so.
And they deserve credit for having noticed it at the time.
They do. And Rosengren as well. And
Bullard.
Bullard.
Yes, and Bullard.
And this was what I wanted to get to. Mark Olson was the last governor on the Federal Reserve Board to dissent. We haven't seen that since Greenspan was in office, the early 2000s.
Yeah, the Federal Reserve is dominated by the conventional wisdom.
But do you think we might see Christopher Waller, because Bullard is going to be rotating in? So he was Bullard's former director of research.
Yeah.
And he has said housing is white hot. And I would be curious to see if we could finally see a dissenting governor, especially because Bullard is going to be voting with him.
Well, we well could. And the matter of the the consensus of opinion is something that we all have to deal with. I've been dealing with it for a long time. I want to give you a little quote, which I think captures it really well. It comes from Margaret Thatcher. And if you get a chance, you can look up her full statement. She goes on about how everybody quotes it, everybody knows it, and we all use it even though we know it's not valid because we don't know the way forward. And so rather than trying the way forward, we just spout the conventional wisdom. And then she concludes by this following quote: "What great battle was ever fought and won under the banner, 'I stand for the consensus'?"
Very, very, very apropos to the moment we find ourselves in. All right, so we're gonna wrap up with you telling me a story that I heard a snippet of. You are 31 years old. You've been at the Fed for all of 2 years, and you're approached to debate an individual.
Yes, I was.
So what was the origin of that, and who was that individual?
Okay.
And where was he at the time in the Federal Reserve System?
Okay, he was not the Federal Reserve, he was the Treasury.
Oh, he's Treasury. Yes,
He
yes,
was
yes.
the Treasury.
By the way, I'll share one anecdote with you. Who was the Undersecretary of the Treasury when Solomon Brothers blew up? That would be one Jerome Powell.
Really?
He's the one who
You
worked
got
with,
me on that one.
He's the one who worked with
I
Warren.
totally forgot that.
Yeah, Jay Powell worked with Warren Buffett. At that moment in time, he was the Undersecretary of the Treasury then.
I didn't realize that.
Yeah, Jay Powell
Hooray
knows.
for you, Danielle.
Jay Powell knows. He understands markets. He understands banks, and yet we still saw him stand down, which is a tragedy. But anyways, who was the debate with?
Well, there was a very famous international monetary conference that was held in North Carolina. It sort of floated around, and they would get a major bank in the U.S. to sponsor it as it would go from year to year. And in 71, it was in Charlotte, North Carolina, and the event was sponsored by North Carolina National Bank at the time. And a lot of central bankers came from around the world, and various Federal Reserve officials and so forth. And the very, very hot debate was whether or not the United States should stay on the Bretton Woods system of fixed exchange rates, or whether we should allow the dollar to float. And the overwhelming opinion of the Federal Reserve and Wall Street and the administration was that the Bretton Woods system should continue. The main academic advocate for the floating exchange rate was Milton Friedman. So they decided that they wanted to have a debate at this conference on staying with Bretton Woods or go to freely floating. And so they were trying to find someone in the Federal Reserve System to take going to freely floating. And the only one stupid enough to say that he would do it was me. And because I was an advocate, I thought it was a good thing. I subsequently regret the fact that I favored that decision because I think it has not worked for us. But I debated Paul Volcker, who was Undersecretary, I'm sure that Paul Volcker won the debate among the attendees there. My view was very unpopular, but I was glad to have the opportunity. And of course, it introduced me to Paul, and later on, we became very good friends. And I greatly admired Paul, and of all of the Federal Reserve chairmen, in my opinion, he was the greatest of them all.
Yes, I have a shrine.
He was, and could I just say why I think my support of the floating rates was not wise?
Well, that's the punchline.
Yeah, that is the punchline. When Nixon closed the gold window and the dollar started floating, I felt that this would be a good thing because it would allow free markets, and I'm for free markets. And I believe that free markets work best. I like the invisible hand. It's one of the most important concepts to me.
Absolutely.
Everybody working for their own benefit, we produce the ultimate good. And I still believe that. I'm still for free markets, but there was an unintended consequence. And economists have a responsibility to identify the seen and the unseen. And what I failed to do was to visualize the unseen. And as long as we were on Bretton Woods and the dollar was fixed, there would be, and we were engaging in errant monetary and fiscal policies, the markets would sell the dollar and there would be a gold outflow. And so we in order to maintain the dollar's stability, we had to sell them our gold, and the gold in Fort Knox was going down. And as the gold bars went down, it got reported, and it alarmed people. And so the monetary and fiscal policy makers then had sort of a servo control mechanism that was operating on them. And there were multiple times where the budget deficit was reduced, monetary policy, we raised interest rates. We engaged in something called Operation Twist for a while to try to stabilize the dollar, which didn't really work. But we were doing that because the gold was leaving the country and people were alarmed. And so once we floated the dollar and it became unimportant what happened when the dollar went up or went down, because there was no commensurate gold outflow, then monetary policy had a free hand and fiscal policy had a free hand. And instead of making wise decisions, they made bad decisions. Now, I want to say one thing in Friedman's favor. He was a great economist. I learned a lot from him. I think he sensed that something untoward was happening, because there, toward the end of the 70s, he actively campaigned for a constitutional amendment to require a balanced budget on an annual basis.
Imagine that.
Unless there was a 60% vote in both the House and the Senate and the President agreed. In other words, you just couldn't run a deficit willy-nilly on a majority vote, that you had to have a super majority. If you were in a wartime situation or some sort of economic calamity and you got your 60% vote, Friedman was all in favor, okay? There might be circumstances on a limited basis when you get a 60% vote and you don't run a balanced budget. Reagan won the 80 election. Reagan was in favor. And there was actual bipartisan support in both the House and the Senate. And there were votes in the early 1980s. We knew that if it got a 2/3 vote in the House and Senate, it would go to the states, and the states were certainly going to ratify it. The votes got a majority, but they did not get the 2/3. And so consequently, the effort failed. But I think Friedman sensed that the movement to floating exchange rate had freed up monetary and fiscal policy to act. In other words, we all say that monetary and fiscal policy should be discretionary. We want the wise folks that have the monetary and fiscal strings to act on our behavior. But I think it's increasingly clear that we do not want them. We want to give them the latitude to act within ranges.
Right.
but we don't want to give them such latitude that they make mistakes that are harmful to us all.
Well, I think you're describing sound money.
That's what I am describing.
Which is
And you've been one of our best advocates, Danielle.
well,
You're on the front line more than anybody that I know.
we need sound money.
We do, we do.
Something has to put
Thank
the country
God for you, Danielle.
back on track. Thank God for me. Okay.
It's on your shoulders.
Oh, great. I think we can end this interview now. My shoulders are feeling very heavy. Lacey, this has been fabulous.
Great fun.
I've learned a lot. I can't wait for my next trip back to Austin, and we can visit with each other again.
Always fun.
After the policy error has been made, then we can do the forensics.
Okay.
Thank you so much. I really appreciate it.
My pleasure.
Well, it's hard to recap what I just experienced. There is no greater teacher of economics than Dr. Lacy Hunt. So what an amazing privilege. You're probably going to have to watch that one a few times. I'm going to go back and take notes of everything he talked about and all that rich history of the Federal Reserve. If for some reason you haven't seen a recent episode of Down the Middle where I interviewed former Philadelphia Fed President Charles Plosser, go back and watch that, because he was also somebody who was an advocate for independence, the independence of the Federal Reserve, and how critical it is, and how far astray the Fed has gone. And I'm going to throw a shameless plug in here. I've learned so much from Dr. Hunt. If you're not a Quill Intelligence subscriber, you should be. You should go onto my website, quillintelligence.com. And it's an education. Our subscribers thank us every day. Until the next time, and hopefully we can get Dr. Hunt back on pretty soon. I'm sure you'd love to see it. But until the next time, I want to thank you for your time. This is Danielle DiMartino Booth with Down the Middle.